In Florida, a lack of workers' compensation coverage is viewed as an immediate danger to public health, safety, and welfare. Many business owners think of a workers' comp audit as a mild administrative annoyance. Your insurance agent might tell you to just mail over your 941s and a payroll journal, and that's the end of it. But an audit is actually a ruthless enforcement action executed by the Florida Department of Financial Services under Statute 440.107. This statute grants investigators the authority to walk into your business and demand your records without a warrant. If they find your coverage lacking, they can issue a stop work order. A stop work order is a legal mandate that immediately halts all your business operations and freezes your job sites until you pay the resulting penalties. Trusting the standard industry inertia of simply mailing in your paperwork leaves you blind to these enforcement powers, turning a routine records check into a sudden, catastrophic business closure. The enforcement gets much more intense if you operate a physical worksite. If you run a construction firm in Florida and your annual premium exceeds $10,000, the law requires the carrier to perform a physical on-site audit every single year. Auditors look past the spreadsheets. They physically walk the site, assessing the boots on the ground to cross-reference the actual labor being performed against the payroll classifications you reported. Say an employer tries to save on premiums by falsely reporting a high-risk roofing crew as low-risk clerical office staff. The state views this as material misrepresentation. The state's escalation protocol for this lie is unforgiving. In addition to back premiums, the Department of Financial Services files felony charges for workers' comp fraud. Workers' comp fraud is a criminal offense where an employer intentionally misreports payroll to evade insurance costs. This gauge illustrates your experience mod, a multiplier used to calculate your premium based on historical safety and payroll data. When you feed incorrect data into the system, it ruins your experience mod score and inflates base prices for years. Attempting to hide your operational risk through misclassification guarantees criminal prosecution and permanently destroys your company's financial risk profile. Even if you accurately classify your primary staff, you can still fall into a severe administrative trap by failing to keep precise daily time records for short-term casual labor. This bar chart shows the mathematical impact of imputed payroll. Imputed payroll is a legal penalty where the state punishes missing documentation by assigning an undocumented worker a weekly wage equal to 1.5 times the statewide average, utilizing a massive multiplier to penalize your bookkeeping. Looking at this chart for the 2024 calendar year, that means you could be forced to pay insurance premiums on a phantom salary of over $1,500 a week for a laborer who only swept floors for 2 days. Standard industry advice focuses entirely on your W-2 employees, which leaves you unprepared for the financial impact of this aggressive multiplier on your casual labor. In a state audit, a minor bookkeeping oversight for a temporary worker mathematically multiplies into a massive, unjustified financial drain. Another massive vulnerability comes from how you label your workforce. Many business owners operate under the myth that simply calling a worker a 1099 subcontractor automatically removes them from your audit liability. The strict audit rule is that a 1099 tax form means nothing during an inspection. If you cannot provide physical proof of a subcontractor's individual exemption or their own workers' comp insurance policy, the auditor instantly reclassifies them as your employee and adds their entire contract price directly to your payroll. This flowchart illustrates the threat of subrogation. Subrogation is a ruthless debt collection mechanism where an insurance company pays an injury claim and then legally hunts down the responsible party to recover the money. If your uninsured contractor gets hurt, their medical bills bounce off them and hit your policy. Because you failed to secure their proof of insurance up front, the entire financial penalty of that subrogation lands directly on your books. Assuming a 1099 label protects your business is a legal illusion that leaves you vulnerable to catastrophic third-party medical claims and crushing audit penalties. You have to stop viewing an audit as a standard review and start treating it as a legal defense. The state uses an aggressive 24-month look-back period, meaning they comb through 2 full years of your records to calculate and demand back premium. Defending yourself requires taking proactive steps long before the auditor knocks on your door. You need to build a complete subcontractor certificate of insurance log and an officer exemption registry, maintaining them rigorously throughout the year. You must execute a 14-point forensic review on your own books to identify misclassified labor and close those documentation gaps internally, well before the state ever has a chance to discover them. This document outlines a critical financial loophole. If you are a first-time violator, Florida law automatically grants you a 15% reduction on your audit penalties, provided you follow specific procedural steps. To secure this 15% discount, you must complete the state's online workers' comp tutorial before the audit is finalized, and you must provide all requested documents to the investigator within a strict 21-day window. Proactive preparation breaks the compliance illusion. By mastering the rules, you diffuse the state's mandatory complexity and successfully protect your company's cash flow.